Firstly, thank you everyone for making some time today. I know that it's probably your morning, so hopefully you've got your coffee or your lunch in front of you. We're going to give a little bit of an update from the Atlas Wealth Group. I've got Jack Henderson online with myself from Henderson Advocacy, so very excited to pick his brains about a bit of a property update, and then myself, Jeremy Harper, Director at Atlas Mortgages. I'll be talking a bit of a mortgage update. Obviously, we had the RBA meeting this week, so there's obviously always lots of exciting news coming through the pipeline. So we'll dissect some of that. So let's get into it. So a little bit of a disclaimer today. Obviously, today's a general presentation. So if you do need any specific advice, please reach out to the appropriate professional, and they'll be able to help you out. So a little bit about Atlas Wealth Group. There's offices set up in Australia and also in Dubai, one of the leading expat financial advice, tax and mortgage providers going around. So regulated by ASIC, ATO and the DFSA, clients across 50 different countries and managing over nearly $250 million in assets. So very specialized in what we do, looking after expats. And that's a little bit about the group. I set up Atlas Mortgages, but also there's Atlas Wealth Management on the financial planning and Atlas Tax. So you can reach out to those teams if you need some specific advice. And then the lovely young gentleman on the call today, Jack Henderson. So a little bit about Jack. He's the director at Henderson Advocacy and also Endeavour Build. So no doubt we'll chat a bit about the build side. He's a property investor himself, property portfolio value of over 35 million. He's got offices across the Eastern Seaboard, and he transacts over $1 billion in purchases per year. So agenda for today, it's going to be quite short on our side. I'll be giving a bit of a mortgage update. Jack will come in and give you a property update. And the main one is that big Q&A session at the end. So if you've got any questions, as Jack was saying earlier, put them in the Q&A box. We'll try and get to them. We always find that that's where the gold is, and that's what people are thinking about. Obviously, many questions coming out of either mortgage or property side. So please don't be scared. Put them in there. Anything you think maybe silly question, I guarantee someone else is thinking that. So on the mortgage market update. So I'm going to go through a couple of trends, some tax updates, and then what I'm seeing with my clients on the actual property and the finance side, particularly. So firstly, what's rates doing? Well, the RBA met yesterday. As expected, they held rates. So we're sitting at 4.35. We've had one increase over the last sort of 16 months. So I guess you could call it we're pretty much at the peak or thereabouts in terms of the central cash rate. Speaking to some economists, so at CBA, they're predicting a rate cut December this year. NAB's got one penciled in for February, March next year. So, the market is anticipating rates will come down in the near term. But the RBA, as I said yesterday, the governor said that she's focused on getting that inflation back within that range. And then this morning we had the monthly CPI read. So the trim median came at 3.4%. So it's heading in the right direction, but there's still some stickiness there, which is actually driven a lot by government spending. So if you speak to the RBA, she's definitely of the opinion that there's no rate cut in the short term. But if you speak to the banks, they've got a different opinion. So what's happened with mortgage rates in general, which everyone will be interested in. So the Fed cut 50 points recently, and then they've also factored in another 50 points to come before the end of this year. So that's 100 points off their central cash rate, which has actually brought down some of the overseas funding costs, which we've already seen that reflected in customers' new fixed rate. So you can see a lot of banks have passed on up to 0.8 or 80 points reduction on that 2 and 3 year fixed loan. That's quite common. A lot of banks already passed that on. And so I think taking a step back, maybe there's a question for a lot of you on the call is, I'm coming off a fixed loan, because it's a question I'm having a lot at the moment. What do I do? And I would just sort of caution to say, don't jump into going ahead and fixing your loan straight away. Have to think about what's happening with the market. Banks are still discounting that variable rate for existing customers. So let's go back and see if we can renegotiate it. Because at the moment, banks are more attracted to discounting the mortgage rate for existing customers than new customers. Sort of 12, 18 months ago, it was a refinance market, cashbacks, hot rates for new business, but banks are looking after existing customers. So I guess my advice there would be, number one, what can you get in terms of discount on your current variable rate? before we see what happens with the RBA, before you go ahead and lock in for another 2 or 3 years. So the question I get is, can I refinance as an expat? Yes, you can. The two key considerations really, serviceability and equity. If you've had a property for the last couple of years, equity shouldn't be a problem. It's going to come down to serviceability. And so qualifying for, a new loan is very difficult in this environment with the stress testing from the banks, and particularly with everyone's outgoings and commitments increasing the last couple of years. So that's going to be the key consideration, which is always a little bit harder for expats with the FX discounting on top of that. And then, so another question I get is, because I'm an expat, do I pay some sort of premium on my mortgage? Is my mortgage more expensive because I live overseas? Well, the answer is no. So if we're getting you a loan through a big bank, a mid-tier lender, that investment rate will be exactly the same as if you held that investment rate in Australia. The banks are really concerned about your actual status to Australia being, are you a resident? Are you a permanent resident versus, or a citizen versus being a non-tax resident? That's not such a consideration. So that's sort of a little bit of a fear that's out there that's not actually entirely correct. And then a little bit further to that. So for people that are looking to buy a property, people want to understand the difference between investment loan and owner-occupier. The biggest difference really is there's a premium in terms of that rate. So if you're taking an investment loan, it's going to be sort of 25, 30 points higher than owner-occupier. So maybe as an expat, you're thinking, I'd like to buy a property now, rent it out, and then perhaps move back into it with my family and say 3 or 4 years when I'm looking to repatriate back to Australia. So during that period, yes, it will be investment loan. But of course, when you move back into that property, you're changing the purpose. So we can go back to the bank, readjust that down to an owner-occupier, bring down that investment rate. So what are some of the changes that have come through? Yeah, so property is sort of a hot topic when it comes to tax changes and the election cycle. So if you think about for investors down in Victoria, big changes around land tax, dropping down that tax-free threshold. So basically now, if you've got investment property in Victoria, you're now wrapped up and you're paying annual land tax. It wasn't the case previously. So that's having a huge impact on the investor market in Victoria. So that's why, and Jack may talk about this later, why you're seeing a lot higher listings down in Victoria, because some people are looking to exit the market, but perhaps try and exit because of the cash flow of that additional cost. New South Wales, not as acute. They've frozen the land tax indexation, which just means $1,073,000 is your land tax threshold. Historically, that's pegged to indexation, like with inflation, but now they're saying let's freeze that. So it's like bracket creep, like your income tax. It just means you'll start to pay a little bit more land tax into the future in New South Wales as that land value appreciates over time. And then obviously stamp duties, the state governments have definitely benefited from higher property prices because the stamp duty hasn't reflected that. So they're just getting a higher collection in that duty. And then in terms of rental changes, so renters, some of the laws and policy that sort of got pushed through in Victoria, that's having a huge impact on some landlords. So I know, at a high level, they talk about, okay, we want to have high energy standards for our rentals and for our tenants. That all sounds great, but what that means is a higher cost for the landlords. So, they might be having to replace air conditioning units. So it's higher cost, insulation, etc. And that's ultimately going to get passed down the tenant via higher rentals, or again, exiting that market and putting higher pressure on that vacancy in terms of the rental pool. And then finally, the federal election is going to be coming through next year. This is going to be the key topic. Everyone's sort of doing a handball around how do we actually fix this housing crisis, but we're starting to see some pretty out there policy. The Greens just recently, Greens being Greens, they said that the Fed should jump in and force their hand and make the RBA cut the interest rate, which is pretty crazy. And then just recently floated that sounds like negative gearing is going to be back on the agenda for the election next year. So just keep ahead of what that looks like. What's that policy going to look like heading into next election? Now, some trends. So this is just a couple of examples around what I'm seeing with my clients. So, accessing equity via refinance. I think for me, the key one that I'm seeing here is, and I never had this conversation going back a few years ago, is people with children. I've got children, but people as children are getting a little bit older, parents are starting to think about how can I help my children today and not necessarily help them through my estate in 15, 20 years' time when I've passed. And so I'm seeing a lot more parents getting through the idea of, I'm going to pull some equity out and I'm going to gift that to my kids as a deposit, or even try and get a property now that they will ultimately take control of when they're of age. And that's just not something that parents are thinking about in the future. And I think that's off the back of what's just happening with the property shortage we've got here. A lot of parents are realizing that their children in the future probably won't be able to get into the property without some sort of help in the future. So that's something I'm seeing. And then obviously, you know, people getting money out for renovations, debt consolidation if they've got some unsecured debt, and even equity if they're looking to buy a property overseas and they need some sort of deposit against end value, which means what is that property going to be worth once it's complete? We are having issues around that type of valuation is coming shorter because the values are quite risk off in this environment. But we're starting to see that, you know, that type of transaction is becoming more and more common as people are trying to build and add more stock onto the market. And then finally, you know, duplexes and granny flats are similar. On the duplex, they're trying to build a 2-on-1, but the granny flats, and Jack will probably talk on this a little bit, is becoming quite a popular type of transaction. I think probably 5 years ago, a lot of Australians would have turned their toes up at the idea of renting as a renter in a granny flat, but it's come a long way. Space is a premium here, so you know there's lots of blocks out there that are suitable to have a granny on the back or on the side, and also we're starting to see that some of these granny flats are beautiful. You know, they're 5-star, they're luxury. So it's a really nice little self-contained dwelling that they can rent out. And then for the investor, you're getting that dual rental. So you're getting that higher gross yield on that type of transaction. So that's me wrapping up my end. I'm going to throw it over to Jack. He's going to give us a little bit of a property update.
Very well done, Jez. And that photo there on the front cover is a house we just bought in Vaucluse for a client, actually. 19.8 million. There we go. Okay. So guys, like Jeremy said, I run a company called Henderson Advocacy, and we also have another company underneath the brand called Endeavour Build. And essentially what we do is we build investment portfolios for clients on the property side of things. And the reason we have the building company attached to the firm is to be able to buy properties, add value to them through renovation, subdivide, build granny flats, all the stuff that Jeremy just mentioned. Because what we found in the current marketplace in most regions in Australia is that the unrenovated house or the unrenovated property in a really good quality location is selling for much less than what it would sell for if it was renovated. And the main reason for that is because there's obviously a stigma in the marketplace that renovation costs are very high, which, you know, they're definitely higher than what they were. But generally the disparity between what we can buy something for and what it's worth once it's renovated is still greater, and we can generate a lot of capital and also manufacture our rental yield as well, like Jeremy mentioned. So what I wanted to really do quickly is I wanted to run you through how we look at property investment and how we build out strategies for clients. I know this image is a little bit blurred, but essentially that's Hendaringo, that's our company mascot. And you can see at each stage of the investment journey, Hendaringo is doing something slightly different. And we break it down into 5 clear stages when we're investing. It's accumulating wealth, it's accelerating our wealth, it's incubation, then consolidation, and then we go through an evolution phase. So I just wanted to talk through those just so you've got some more context when I'm talking about other stuff. So if you're starting your wealth creation journey now, you might have an owner-occupier home, but nothing else, for example. You might have some shares, but no property. Essentially what we want to do is in this accumulation phase, we want to actually grow our asset base. So from our point of view, this is generally when you're going to be carrying higher loan to value ratios. You're going to be taking advantage of a lot more leverage. And the main reason for that is because you're trying to acquire assets and acquire a large enough asset base. So when the marketplace moves, we're actually going to start making some money and building our net worth. And then once we've built an asset base, that could be over 3, 4, 5, 10 years even, depending on how young you're starting. Generally, you're going to come to a position where you hit a serviceability limit. And Jeremy knows that better than anyone. You know, banks will only lend people certain amounts of money regardless of how good your structuring is or how much money you earn. So what we then do is once we hit our serviceability limits, we then go back to the existing portfolio and we go, well, what can we do to the existing properties in the portfolio to make them worth more money and to make them bring us in more rental income and also to make them more tax effective? And that's that acceleration phase that you can see there, Henderson sitting in what looks like a Ferrari. And essentially what we do there is we'll go and add value to property. So we might renovate an existing dwelling, add a bathroom, potentially increase the rental yield by adding a granny flat, or looking at how we can potentially subdivide a block to increase again the net value of that asset. And then the next stage, sorry, the investment journey is probably the most boring stage, but it's the stage where you make the most amount of money, and that's that incubation stage, which is essentially, if you think about, a chicken when it lays an egg, or you put an egg inside an incubator, it's essentially just sitting there and you're waiting for that egg to hatch. And that's how we look at our incubation stage. It's, you've built an asset base, you're probably carrying a relatively high level of debt against that asset base. And now what we need is the marketplace to do the heavy lifting, because even if we don't pay $1 of debt off our portfolio, so hypothetically speaking, let's say we've got $3 million worth of debt and we've got a $4 million asset base. If we pay interest only on $3 million, but that $4 million property portfolio goes from 4 to 8 or from 4 to 12 over a 15 or 20-year journey, all of a sudden the same amount of debt against an $8 or a $12 million portfolio seems much less relative, and your loan to value ratio is much lower, just simply due to the marketplace increasing. And I'm assuming everyone in here has a relative, a grandmother, grandfather, auntie, uncle, or whoever it is who's bought the property in the 60s and the 70s. They've literally done nothing to it other than hold it. That would be the incubation phase, and they sell it many, 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 many years later, or someone inherits it and they sell it for many millions more than what Nan and Pop paid for the property. And that's really how we see that stage, is building an asset base, letting the marketplace do the heavy lifting. But then as we go through the consolidation phase of the portfolio, generally speaking, even when you hold residential assets for a very long period of time, the cash flow on those assets usually isn't that strong. So in residential assets inside of Australia, a really good rental yield is 5.5 to 6% gross. An average rental yield is probably 3%, and a not so great rental yield is probably 1.5 to 2%. And now by the time you factor in your interest costs, your land tax, your property management fees, your maintenance, all the stuff that goes into holding property, you're left with nothing a lot of the time. I was talking to someone recently who had, $30 to $40 million worth of assets, almost no debt. And by the time they factored in all of those costs and they weren't even paying interest, they were left with almost no money. So what we have to do is we use residential assets to grow our net worth, because we're able to take advantage of a lot of leverage. We can put in a small amount of money and get a lot of money from the bank. We grow our net worth. So like I said, that $3 or $4 million asset base going to 8 or 12, we then will start to sell down the asset base. The unfortunate part of this part of the journey is we sell down, we have to pay the tax man, unfortunately, but it's all a part of the journey. And what we want to do is we want to decrease our debt level and then repurpose the capital that we have. And that's when that evolution phase comes in. So we'll repurpose our capital, and we generally will start to put that into either commercial assets, or we'll put that into something else that's going to generate us more cash flow, which, the Atlas Wealth guys will be able to help you out with, because we've built our wealth now. We're at the stage of our journey where growth is no longer as important. Cash flow is more important. And we want to start putting that capital that we've generated into assets that are going to generate us a much higher net rental income. Our asset of choice is commercial, because net yields mean the tenant pays for all the outgoings, even things like land tax, and really the only cost that you have is interest, and interest expense if you're carrying debt. So if anyone's got any questions on that structuring, chuck them in the questions box. But that's essentially how we think about investing. It's accumulation, acceleration, incubation, and then consolidation and evolution. So property prices in the current climate. So we'll run through some trends, and we'll also run through some data. We might do the data first. So median home values in Australia at the moment are sitting at just over 800,000 Australian dollars. That's up slightly from 798 in July. Now, to be honest, I don't really get caught up in the micro all that much, because things change every month, and the reality is, when you're buying real estate, you're buying real estate not for 1 month, 2 months, 6 months, 12 months. You're buying real estate for 12 years, ideally, because the longer you hold it, the more money you're going to make. But essentially what this tells us is that the marketplace is moving in an upward directory. Even though it's moving in a slow upward directory, it's still moving in that direction, which means every month that you're not in the marketplace, it's costing you more money. Now, the interesting thing in recent times is that Perth, as a median, has actually overtaken Victoria. I know Jeremy mentioned some changes in Victoria around land tax, and that's one of the main reasons investors have decided to, boycott Victoria for the time being, is that the holding costs inside of assets inside of that state are less appealing. I see that as a massive opportunity. Like, Melbourne's going to be our largest city in all of Australia. It's got some of the highest paying jobs. We've got some of the most expensive real estate in all of the country there. And it's just a point in time at the moment where it's not the flavour of the month. But not very often can you buy houses at a medium value in one of the biggest cities in Australia cheaper than what you can in somewhere like Perth, which is obviously heavily reliant on the mining sector. So a lot of opportunity I see in the Melbourne marketplace to buy when others are not, or zigging when others are zagging. Obviously, interest rates at the moment are still in a similar position, or the same position as they were 12 months ago. But as we're seeing with the Fed being cut, or cutting rates by 0.5% in the US, and now, in the AFR today, now that the chat is out about what's going to happen in the Australian market, CBA's predicted rate cuts in December of this year, and the other three of the big four banks have predicted rate cuts in the first 4 or 5 months of next year. I take that with a grain of salt. But the positive thing to come out of that, and the thing that actually moves the marketplace before rates decrease, is the sentiment in the marketplace. Because what we find is, when the overall market feels like the future is likely to be better than the past, they move with a lot more confidence. And we've seen it time and time again. COVID is the most recent example of it, where, all of a sudden the market can move 10, 15, 20% literally in 6 months. And it's not reflected in the data that it's moved by 20%, but that's because there's a lag in by the time people purchase and the time they settle, and then by the time that settled data actually gets reported. But if you're on the ground in a marketplace, a property can sell for 800 grand today, the market moves, there's more buyers at an auction, that same property could sell for 950,000 or $1 million next week or next month, just simply due to how rapid the market moves. So that's what we're likely to see as this good news stories get out there about interest rates. Buyers will act with more confidence, and I think the marketplace will move very, very quickly in a pretty short period of time. So what opportunities are we seeing in the marketplace right now? So I mentioned one. That's me and my building team standing out the front of a property that we actually renovated. Now, a lot of opportunity in unrenovated opportunities, because one, people don't want to buy a property and do the work to it. And two, there's that stigma in the marketplace about building costs. So if you can buy a really good quality asset in a good quality location and add value to that property, it's a really good way to be able to get you into your next asset very quickly. And this actual example, we spent $960 on that property. I think we spent $240, $250 on the renovation, ended up getting a reval post reno at $1.4 million. So that client was able to pull all of their renovation money out of the project, plus some profit on top. It ended up renting for $1,000 a week, and they rolled that capital into their next opportunity. So instead of paying $1.4 million for that property finished, we bought it for $960 and did the work ourselves. Plus, then you get depreciation benefits off the back of it, and obviously the increased rental income. So there's a big opportunity there still in the renovation space. I actually think the marketplace is likely to reprice in a pretty big way, because at the moment there still isn't as much disparity as the market generally shows, and that's because construction costs have moved much faster than property prices have moved over the last 36 months. So property prices are likely to move much faster in the next 36 months than construction prices, because there's no real reason construction prices and materials will increase. So I think that gap is only going to get bigger as time goes on. As property prices grow, construction prices stay the same, I think we'll start to see feasibilities on developments stack a lot more, because at the moment, it's almost impossible to get a apartment building or a duplex site or anything like that to actually stack from day dot, just due to the price you got to pay for the land and the cost of building that property. Now, I was just going to go back to that last slide. Sorry, Jez. You'll see it's not to just say on this one. I can just talk to the slide. Oh, there we go. So one of the things that you'll see there and point to is identifying high growth suburbs or undervalued properties. What we've been seeing a lot in recent times is investors getting into the marketplace and going into the market with that stigma of, I want to try and make $1 million overnight. And we're seeing a lot of people invest in regional locations and locations that haven't performed historically, but they believe because they're affordable and they've had some short-term growth that it's a good place to invest long-term. So one of the things that I just reiterate to people every day I speak with them is make sure when you're investing in property, you're not investing for the next 12 or 24 months, you're investing for the next 12 or 24 years. Because, I can show you lots and lots and lots of data and reports. And if anyone follows me on social media, I always put the content out there to show if you're investing in a regional location, for example, like Mackay or Toowoomba, or, in certain places like Perth, if you look at the last 15, 20, 30 years worth of historical data, these areas haven't performed. And I can near guarantee if you looked at the historical data before you make a decision to invest in that location, you wouldn't invest there. So we just want to make sure that we're always investing in locations that have a proven track record of performance, because that gives us a lot of confidence in the future they're likely to do very, very similar. Thank you, Jeremy. Prediction for the next 6 months of buying, or the next 5 or 6 months of buying. Traditionally, spring in a lot of the capital cities around Australia is the main selling and buying time. I've sort of got 3 or 4 months before Christmas where a lot of transactions will happen. I personally think it's going to be a very strong spring, especially in comparison to last year, just simply due to the positive sentiment that'll be in the marketplace around interest rates. And if what Commonwealth Bank is predicting comes to fruition with an interest rate cut in December, I can near guarantee that the start of next year will be much earlier than after Australia Day, which is generally when the marketplace kicks off. There still is a massive imbalance between supply and demand, way more demand than there is supply, and that's not going to get better. And the main reason for that is simply due to people's serviceability being limited with interest rate increases. They actually don't have the capacity to go and sell and rebuy another property at a higher price point for people upsizing, and there's a lot more people upsizing than there are downsizers. The other reason for that is that Australians are actually holding their homes longer than they ever have. So the average hold time 10 years ago in Australia was about 7 years, give or take, depending on where you live. Right now, the average hold time for property is just over 13 years. So it's almost doubled in the last 10 years, which means every time a property sells, it's unlikely to hit the market again for another 13 or so years. And that's due to the high entry and exit costs in property. So the stock is not going to get better anytime soon. Plus, on top of that, we've got a huge amount of migration happening into Australia, and building approvals and building levels are the lowest they've been in a very, very long time. And again, that's due to what I said before, with development sites just not stacking, and a lot of the approvals in your local government areas around planning take way too long, and it doesn't help supply. So we have a massive imbalance between supply and demand, and that's it's only going to get worse as time goes on. We've run through how the RBA rate will impact the marketplace. It's going to have a positive impact just on sentiment. It's not going to dramatically change people's repayments at all. A 0.25% decrease on $1 million mortgage is $2,500 a year, or $50 a week or thereabouts. So it's not going to dramatically increase someone's cash, but it is going to dramatically increase someone's positivity in the marketplace and how they will act.
Yeah. Thank you, Jack. That was great. And just before we bring this home with things to do in a Q&A, I just wanted to piggyback on a comment you had there about the construction costs, because I think this is really important. And I was trying to touch on this earlier with construction type financing. But what I'm seeing in the market with the valuer, coming back to my point, was, let's say we've got a customer that's looking to buy a property for $1 million, and the valuer gives us the report. The land value is, say, 600. The dwelling cost is 400. So that's what they value the dwelling by itself. But then they put in the insurable value. So what does that need to be insured for to rebuild? Their comment is it needs to, be minimum insured for, say, 650. So that goes back to what Jack's saying, where you're seeing they're actually not even valuing the dwelling appropriately, the cost, by saying that to actually rebuild it would be much higher than what we're marking the dwelling cost on our valuation report. So yes, that should correct itself in the next couple of years. That's what I see, because I just see there's a bit
I
of
think the market will reprice for sure. Yeah. It's not sustainable as it is right now. A lot of, like with finished products, a lot of the time you can buy them cheaper than what it would cost you to replace that product today. We say that constantly.
Yeah. And that becomes a really big issue when you're trying to rely on that equity to get it financed. So there's just, it becomes not a great outcome for the borrower for that type of transaction. So things to do as we bring this home. If you like to listen to my dreary voice and help put you to sleep, we've got a series of podcasts, so you can jump onto Spotify or Apple or SoundCloud. Make sure you subscribe to those podcasts. They'll come out every sort of week. If you're onto Facebook, I know this is one of Brett's little babies that he drives. So jump on there, interact with the team at Atlas on Facebook as well. Any questions you've got, I'm sure they'll get answered. This gets me, I'm very excited about this. We'll put a lot of time and effort in arranging our big roadshow next month. So if you're dialed in from either of these locations or these cities, please come along. Email through to events@atlaswealth.com. We'll make sure we secure a ticket. Jolie, who's head of marketing, is on the call. So she'll come back to you, get you secured. Would love to say g'day, meet you. They're the dates. It's going to be a very busy week. Very excited. So please make the time if you've got that time available. And finally, over to a Q&A session. So again, if we've got some questions flowing through, so it's great. But if you've got anything, please just put that in the Q&A box, and we'll try and get to that. So I've got a couple of questions here. So first one is from Cheryl. So Jack, so you mentioned earlier about building costs. So do you see that improving in the short term, or do you think this will be a constant pressure in the next 12, 24 months?
Yeah, I don't think building costs are going to improve. Like, the costs are what the costs are. And I have this belief, and it's just from me being in the marketplace and seeing it so regularly, is that I believe trades are going to get a lot more expensive than what they are right now. Materials will not change all that much, but I think trades will. And the main reason for that is because there is a lack of trades moving into the marketplace. Like, gone are the days where people wanted to leave school and become a plumber and become an electrician and become a chippy. That's not normal now. And that means that the trades that are currently in the marketplace are going to get, the prices that they demand, because there's not going to be as many skilled trades in the market. What will happen though, which will balance it out, is that property prices will grow and construction prices won't. So although it won't get cheaper to build, the end product will be worth more. So there'll be a margin in it.
Yeah. Okay. I've got a question here from Tom for Jeremy and myself. So my partner is a non-citizen, is a French national. Can she also access an expat home loan? So yes, so Tom, assuming you're Australian citizen, in this type of scenario, we'd recommend looking to see if we can keep the transaction, the title and the loan in the citizen's name only, because if it's a non-citizen on the title is subject to foreigner stamp duty or surcharge per that state you're looking to buy into, which can be an additional 7 or 8% on top of the regular stamp duty for the ownership portion of that non-citizen. And also you won't have access to all the lenders because, as I was saying earlier, they restrict that to citizens and permanent residents. So my recommendation would be trying to get it done in the citizen's name. And Frank, I think also for myself, I have an investment property in Queensland. Can I use the equity in that property to purchase a second property? Yes, you can. Again, subject to valuation, and the key would be the serviceability. So, we can go and get a valuation done up front to see what the numbers look like if you've got an existing loan, and then with serviceability to see what we can afford for that second purchase. And yes, you can use some of the equity as part of that deposit. I've got a question come through regarding negative gearing. So impacts on government changes to negative gearing. So what would the impacts be short term for those purchasing in the next 6 months, and also long term in the next 2 years? I'll throw that over to you first, Jack, and then I'll jump in. What do you think that?
Look, I think it gets brought up every election, right? It's like it's Labor love it because they want to stay in, and a lot of people own property, and it affects a lot of people. So I don't think it'll have any impact. I also don't think it'll get through because they talk about it all the time.
Yeah.
So when they've done it in the past, the way that they've proposed it is that they will essentially grandfather all the people that have owned properties prior to it being legislated, which means anyone who owns properties before it was legislated still gets to claim negative gearing, and any assets you buy after that time will then not take the benefit. But my bet is in the court that it won't change because there's too many people that it'll affect.
Yeah, and I think 2019, that was a key piece of the federal election, and that got voted down pretty clearly. I mean, obviously the environment's changed, but if we're looking at housing from purely a hard stick tax point of view, we're never actually going to get the result we need. As Jack was saying earlier, we need cooperation from council, states, and actually just getting these things built. You know, I know I'm personally working with a council right now. It's a nightmare. And until these things change, you know, taxing people that hold property more is not the solution. So I don't think it's going to get through. But as Jack said, if it does, even the Greens have already said that they propose it to be grandfathered in. So, you know, there'd be a line in the sand. So if you're looking to buy in the next 6 months, it probably wouldn't be impacted. Okay. Question from Michael. So refinancing property in the UK, can we take some of the capital out and then put in your offset in Australia? Yes, there's no restrictions on the Australian side. I guess my comment to that would be you're probably adding a layer of potential complexity because you're now dealing with FX. So if you're taking it, you know, continuing a mortgage or increasing a mortgage over in the UK and you're dealing with repaying it from Australia, so you're paying Aussie dollars, you're transferring it back, and then you're taking that capital back from the UK to Australia, it may work. It may just from a complexity, just have to kind of see if the juice is worth the squeeze in terms of doing that sort of transaction. But you know, putting money in the offset account in Australia, that's not going to be an issue. Question from Mark. So for expats, is it optimal to use higher debt levels or more cash to fund a property purchase? And that's a great question because I'll go first and then Jack, you can jump in if you've got a comment. But maybe there's people on the call that are not familiar with an offset account. So Mark, let's say you buy something for, let's say it's $1 million in Australian investment property. We take out an 80% loan, so 800 is the debt. And so you put down your 200 plus closing costs. And let's say you've got an additional 300 that you could put into the transaction. You can take that 300 and put it into the offset account from day one. So that won't change necessarily the repayments, but you have 300,000 in the offset account, which is reducing the interest charge on the 800 down to 500. So the net of your offset account. And that is a really, really good product available, which I think it's worthwhile for expats, particularly if you're moving money overseas. You know, there's everyday savings accounts, so you're not getting a great return on. You've got essentially risk-free return of call it 6.5%. You're reducing that expense by having an offset account. So my opinion would be, you know, maximizing your LVR as much as possible, and then having that cash in the offset account.
Yeah, I'm of the same opinion. If you can use someone else's money, being the banks, I would always advise that, and then keep your cash handy as dry powder for if things get lean. And the advantage with offset accounts is if the money's sitting in the offset account, it's just like you've paid it off your mortgage anyway, except you have access to the cash. So it's very, very powerful.
That's right.
And we actually had this scenario just, you know, I spoke to you today, Jeremy, about a client who currently is living in Sydney. They've moved back from Dubai, have a big chunk of cash, and she was of the opinion that she was going to put it all into the property. But, you know, my advice to her was, instead of putting $2 million of cash into an asset, put the minimal amount of cash, which would be the 20% deposit you need plus your stamp duty costs. And with the rest of that cash, put it in the offset account and borrow all the money you can. Because if you ever want to use it, you can. And if times get tough and you go back to the bank to ask for the money, unlikely they're going to give it back to you.
That's right. That's right. Question from Mr. Cahill. So as a new starter, it feels completely overwhelming to get into the market at this stage. Where's the best place to start? Ground zero. Yeah, that's a great comment. So obviously I'm in Sydney. I deal with expats. I've got first home buyers in Sydney, Melbourne, in Queensland. It's really, really tough. Doesn't matter if you're an expat or in Australia where interest rates are. So if you're looking at a mortgage at 6%, that's going to be stress tested at 9%. So it's very hard to qualify in terms of your borrowing capacity and then getting that deposit together. I mean, first place to start would be just number one, understanding right now, what's your borrowing capacity based on your current income and your deposit? And then what can you do? What are some small steps you can do to increase your borrowing capacity? And I guarantee every time I speak to an expat, there's things there, there's some fat we can cut, you know, credit cards, there may be car loans, there may be some fun debt there that we can get rid of. That's going to have an impact on your borrowing capacity. And then from there, it's really just grinding away, trying to get some of that deposit down. And then, as I was saying before, trying to see, okay, can we get a high LVR to get into that market earlier with a lower deposit if we're starting out? And then, okay, once we're in the market, revisiting that in a couple of years' time, look to refinance if we get the LVR down and using some of the equity again in the future. So yeah, it's really just taking baby steps and to try and not feel as overwhelmed. But it's a very common feeling, so you're definitely not alone. A couple more questions we've got coming through. We've got from
Jez, can you
John.
just make me host again, mate, so I can put my camera back on?
Yes, there we go.
Oh, beautiful. All right,
There we
here
go.
we go.
I've got a question from John. So I'm a new Aussie expat now living in UAE. What are the key differences in how Aussie lenders evaluate income and expenses for expats incurred overseas? Apologies if you for example. Okay, great question. So for my clients in the UAE, some banks, I think one of the key takeaways is most will take 20% off your income. That's pretty straightforward. And then some banks will say, probably your package is a base and allowances. Some banks will further discount the allowances, and that's quite common. But if we can show to that bank that that's an ongoing allowance, it's not just like a one-off, it's say transport allowance paid every month, we may be able to get that wrapped into the base so it's not discounted again. But the key really is some lenders in Australia will apply Australian tax against your income. So they'll shade it by 20, then they'll apply the nominal marginal tax rates on that income. And then some will say, no, what's going to the bank, 20% off that, and we use that for our borrowing capacity. So if you look at those two credit policies, it's going to yield much huge difference in terms of your borrowing capacity. So that's probably the key to kind of work around. And then, being the UAE, the big things are like if you're renting, I know rents in Sydney are expensive. Renting in Dubai is very expensive from what I see with those rental agreements. So can you not allow yourself to have that lifestyle creep, because that's just ultimately going to eat away at your borrowing capacity. So trying to minimize your outgoings over in the UAE. But yes, I mean, we can definitely go through a bit of a borrowing capacity exercise. That's not a problem. Question from Paul. How easy is it to increase a mortgage secured on an investment property in Australia to help fund a property purchase overseas? Great question. So this comes down to the bank. Some are very strict. They'll just say, as an expat, we don't want any equity released. Some are happy for you to release equity to buy in Australia. And then some can actually allow you to say, yep, maybe give us a contract of sale on the overseas purchase to show that what the source of funds are for, and then they'll release that. But yeah, it'd be subject to a full mortgage application on the Australian side. And then if you need to take a part mortgage on the overseas side, we just need to factor that in to make sure actually once we take on the proposed new debt in Australia for the deposit, plus the balance loan overseas, that we can actually still work and actually, from the serviceability, it still works. Because I guess if you think about it, the biggest difference will be the proposed mortgage. Let's say it's, you don't take a mortgage in the US, the rate will be, say 2.5%, 3% or 4%, but the banks will still stress test that proposed debt on the Australian side. So your borrowing capacity won't be there. But yeah, that's just something to work through the numbers. Question from Benjamin. And Jack, jump in here if you want to add to any of these. As an expat, should I rent out my house long-term or do short-term rental, Airbnb at the Gold Coast? And are there any positive cash flow? Oh, and for any positive cash flow, would you put it into the offset account or invest in shares? That's a Jack question. What do you think about Airbnb?
I think the right property, I call them destination assets. I have one of them myself. And generally speaking, they work much better at higher purchase price because your rental yields for a full-time rental get much lower when you start to spend, a few $1 million on an asset. And if you're buying a house or have a house in the Gold Coast, I'm assuming it's worth a few $1 million. You rent it out full-time, you might get 12 or $1,500 a week. On Airbnb, you might get 3.5 or 5 grand a week, maybe long term. Some weeks you'll get 20 grand, over Christmas in one of my properties, might get 30 or 40 grand for the month of January and December. Then it might be pretty quiet for February, March. So the thing is to make sure it's the right asset. It's going to do well. If it's furnished already, again, you don't have to go to the expense of going to buy furniture and all the rest of it. But it is definitely a pro. The issue with it costs a lot of money. Rough Airbnb rates around the country are roughly 25-ish%, 20 to 25%. Normal management fees are about 7%. So it's much more expensive because they've got to do a full service of the property, sheets, linen, all the rest of it. But it works. And then the second half to that question was, would you put the positive cash flow into an offset account or invest in shares? The way that I would look at it personally is that if I was putting into the offset account was say 6.5%, 7% as an interest rate, you're getting a guaranteed 6.5%, 7% in every dollar you put in the offset account. If you're investing in shares, you may get more. You also may get less. So the arbitrage may not be worth it. So the guaranteed return in the offset account is a potential return if you invested into shares. So that's how I look at it.
Fantastic. And then another question from Mark. So what's a good variable investor loan rate at the moment with the Aussie banks? So a good example with an offset, you'd be looking like up to an 80% LVR, about 6.19 is sort of where we're sitting. That's pretty sharp, actually. That's even pretty sharp for, if you were to take that out in Australia, because I know a lot of clients would be on a higher rate than that. So that's probably on the sharper end, but yeah, 6.19, 6.25, 6.5 is sort of where it should sit. First time follower, long time caller. I had that wrong way. Thoughts on rates with riding the variable wave, or should we be locking in some of the fixed options? So yeah, I talked about that a little bit earlier. I think a lot of calls and conversations I'm having with customers, particularly there's a lot of customers coming off of fixed still, the last couple of months or up until the end of this year, there's still a bulk there. And I think for those customers, they're thinking, oh, well, I'll just lock it in again. And they might be enticed with some of these cheaper, well, not cheaper, but these fixed rates that have been cut recently, as I said earlier, up to about 80 points. I would just take a deep breath about that. Don't make any rash decisions, because if you lock in, let's say you locked in for 3 years and the RBA does cut a couple of times, and then you say to your bank, actually, I want to break this. I want to do something with my loan. I want to refinance. I want to sell, whatever it is, you will be up for a break cost fee. And the more that there's a difference between the interest rate margin when you got into that fixed loan, when you're trying to break it, that you could be up for thousands of dollars. And that does make a big difference if rates move. So, all I'd say is if you're looking to fix, make sure that you 100% sure that you won't be breaking that over that period, and maybe look to do a split, maybe 50% fixed, 50% variable if you want a bit of each way. But it really comes down to, what do you want? Is it you just want that certainty, and I don't want to look at it for the next 3 years and I just want to know that's my monthly repayment? Okay, not a problem. But I do remember speaking to customers off the back of 08, and some people locked in these 5-year rates, and then the RBA cut, I think it was about 125, and they weren't happy because they were on these long-term fixed rates that were completely out of the market, and it would have cost them, up to $10,000 to break it in interest costs or break fees. So it really comes down to what you want to do. If you're happy, if you think you'll be happy to pay a higher fixed rate in a year's time, and maybe you get that upfront benefit with a lower fix now. But if you look at the pricing, it's at best, it's probably 75 point spread between the two. So it's not a huge difference. It's not like you're locking in for 2.5%, where it's a bit of a no-brainer. So it really comes down to yourself. And we've got another question here. So a couple more questions. What's the bank's appetite for interest-only loans? Are they capping out at 2 or 4 years? Great question. So, ANZ will go up to 10 years, but typically banks will go up to 5 years, and that hasn't changed. It really comes down to serviceability. So it's not like they've said, oh, we're not interested. They enjoy interest-only loans. It's profitable for them. It's a good product for the bank. What I would say is some banks will not offer that for expats. So some banks will go, yes, we'll lend to an expat, but the repayment has to be P&I. So if you're asking that as an expat, yes, it's available, definitely. We just have to work through those options and which banks will offer that. So it's not all. And I've got a question for Jack. So Jack, are your clients buying in good areas with some mild renos to get a bit more yield at the moment, or just holding steady and focusing on undervalued assets and waiting for interest rates to drop? Oh, that's a great question.
We're still doing a lot of renovations. So we start anywhere from 15 to 20 renos a month, I would say, on average. So pretty substantial amount, and they vary from $100,000 cosmetic paint, carpet tidy up to, you know, I think the most expensive one we're running at the moment is about 500 or 600 grand, which is for a much grander scale. So still value in the marketplace there. The biggest thing and the most important thing to make sure the reno stacks is buying the property right. You can definitely, you know, overpay for a property or buy the wrong property, do a reno, and actually make your money on the other end. So that's what we do. We still see a lot of value both in capital appreciation and obviously in an increased rental yield. And I'm not sure if anyone looks at the rental market in Australia, but most properties in or up for rent are very average. So you know, if you put something nice to the marketplace that's never been lived in before, you get premium rents and you get better tenants. And then Stephen's put a question here: any markets, Jack, you just won't go near? Perth is a bit weird. Yeah, so I just simply don't go near any marketplaces that don't have a strong track record of performance. That's exactly what I look at, and it's my first barrier to entry to you know, get into a region. Has it performed? Has it not performed? How long has it not performed for? Or how long it has it performed for? Which is the most important thing, because you don't just want to invest in a location because you think it's going to do better in the future, because that's not investing. I believe that's speculating. Melbourne, a lot of opportunity there. Been a very strong performer. Stephen's just asked. Melbourne. Yeah, Melbourne was our strongest performer in all of Australia for the last 30 years up until 2020. The last 2 years, it's taken a bit of a dip, but I think that'll change very soon.
Yeah, I agree.
400,000 pre-approval. Is it impossible? Where should we buy? I would just try and get as close as possible to capital. So like for 400 grand these days, you still get into the Brisbane marketplace. You might get into somewhere like Ipswich, Caboolture. Again, these aren't the greatest markets, but when you're limited with budget, you need to get into somewhere. And I think if you're close to a capital, it's great. You could also get a boutique apartment or an apartment in a small block close to a really good city. So you potentially could get into the Newcastle marketplace for 400 grand. You get into some good suburbs in Adelaide for 400 grand, but they would be apartments, not houses.
If you've got any questions, drop us a note and we're happy to kind of go through in detail one-on-one as well. That's not a problem. But again, look, thank you everyone for your attention. We're coming up to an hour now. I hope you've found it really useful. We've got another session tomorrow. So if you know anyone that needs to jump on tomorrow's session, please pass on our details as well. But I'll sign off now. Have a great day, everyone, and appreciate your time. Thanks, Jack. Thanks, everyone.
See you guys.